Buying tech stocks has never been a bigger gamble. The money pouring into AI isn't new money. It's coming out of companies you already own. IBM just proved it. A quarter of the company gone in one session.
We're getting this warning this morning from IBM, and the stock is down sharply.
Gone in one session. Worst day on record. And that same day, the market closed green.
Nice move in the NASDAQ. Is it justified?
S&P up, NASDAQ up. The money didn't leave, it moved across the street.
This could go longer than 1 quarter if memory prices remain high. B, if the Iran war stuff is not resolved soon.
IBM's customers didn't disappear. They didn't run out of money. They took what they were spending on IBM and spent it on AI hardware instead. Both of those companies are in your index fund, which means you own both sides of this trade. The ones being funded by the AI boom, and the ones being drained by it. Most people are buying the drained ones and calling it a dip. By the end of this, you'll know which is which, and the one question to ask before you buy any tech dip again. Before we continue, if you want more videos that cut through the market hype and show you where the money is actually moving, subscribe, because that's exactly what this channel is built for. Alright, back to the real problem. If you're new here, my name is Martin. I don't work on Wall Street. I don't run anyone's money but my own. I sat through the dot-com years, and I learned what this costs. A spending boom in one corner of tech can starve another. Everyone watches the boom, nobody checks the bill. So stay with me, because by the end, you'll understand exactly why this isn't isolated, and why your portfolio is more exposed than you think. Here's the one idea that makes the whole thing make sense. Enterprise IT budgets are fixed. Let me explain that real quick. A company gets a set pot of money to spend on technology each year, and every dollar that goes to one thing can't go to another. Think of it like a family draining its grocery budget to buy a sports car. Nothing new came in. They just stopped buying the old thing to afford the shiny new one. Remember that, because it's the whole game. So what actually happened inside IBM's numbers? IBM released its preliminary Q2 results 8 days early, which itself spooked the market. Revenue came in at $17.2 billion, missing by over $600 million.
Well, shares of IBM are down sharply today after the company's profit and revenue fell well short of expectations. That's a miss in a big way, isn't it?
It is. I mean, it happens. And look, I mean, I think part of the IBM story, I think people kind of sort of get lost in the weeds. And what we have to do always is take a step back to understand, what's the broader theme here, right? Why is it that IBM did poorly while larger U.S. banks are doing well, and why are some other stocks doing quite well as well? And the broader theme is, look, I mean, this is clearly an AI revolution.
But here's the part that matters. Software growth decelerated from around 11% down to just 5%, and infrastructure fell 7%. CEO Arvind Krishna didn't blame the economy. His exact words, "This quarter, we faltered." He admitted that in the final weeks of June, enterprise clients aggressively redirected their fixed budgets away from software and mainframe upgrades toward buying supply-constrained AI hardware before prices spike. So the boom isn't creating new money, it's eating the old money. The AI hardware surge is literally cannibalizing the software sector's cash flow. And here's why this isn't just an IBM story. The exact same day IBM crashed, the sympathy selling hit everyone. ServiceNow dropped around 8% in sympathy trading. Workday fell around 9%. Accenture, Adobe, Salesforce, all down together. Now watch the other side of the trade. The same day, Dell, HPE, Micron, and AMD climbed. The money didn't leave tech. It rotated inside tech, from the companies being cannibalized to the ones doing the cannibalizing. And this is where it reaches you. The information technology sector is now 39.4% of the entire S&P 500. That's higher than at the peak of the dot-com bubble in 2000. So when you buy the broad market thinking you're diversified, you're really making one concentrated bet on tech staying healthy. Retail is buying this dip, assuming all tech benefits from AI. But one half of the sector is surviving by eating the other half. And if that cannibalization spreads across the SaaS market, the index reprices violently. Now, I have to be straight with you. There's also a real bull case here. Some analysts argue IBM's weakness is idiosyncratic, tied to its mainframe exposure, not proof of a sector-wide collapse.
And there's going to be winners and there's going to be losers out of it. So if you look at US bank earnings today, those are up, and a huge driver of those earnings is these mega cap IPOs. SpaceX, companies like this where they're generating tons of investment banking revenue. But you're also seeing it play out in companies, like IBM, which are the losers of this effect, right? Because, if you look at it, a lot of that spending or that CapEx spending that was geared for IBM revenue from their customers, they've rejigged that to AI hardware. And IBM hasn't kept up as fast, and their business model is probably more under attack from AI than probably most sectors. And so that's why you're seeing that huge change, that huge shift.
Morgan Stanley and Oppenheimer stayed constructive, both raising their price targets and arguing that IBM's underlying contract trends remain solid despite the quarter's miss. They've got a point, and I won't spin it. This might just be a procurement air pocket that fills back in. I could be wrong about the timing. And I've also been early before, many times. But nobody can time this stuff, and anyone who tells you they can is lying. So what am I actually doing? I'm not telling you what to do with your money. I don't know your situation, and I've got nothing to sell you. But here is my plan. First, I don't buy a dip just because it's red and familiar. I ask whether the company's revenue is being funded or drained by the AI boom. Then, I'm watching IBM's official earnings call and ServiceNow's numbers on July 22nd, because that's the test of whether this is temporary or structural. Fear is what makes people chase the winner right before the trap snaps shut. Now, I'll give you one question, and I'll give you how I answer it. Here's the mistake almost everyone is making right now. They think this is software versus hardware, old tech versus new tech. It isn't. The same day IBM lost a quarter of its value, cybersecurity stocks ripped higher. CrowdStrike up double digits. Okta, Palo Alto, right behind it. That's software, same sector, same customers, same budget. It went up. So the line isn't software versus hardware. The line is, can the customer put this off? If a company can delay buying you for 1 quarter and nothing bad happens to them, you're getting delayed. Every time. That's IBM. The deals didn't die, they just didn't close. But if delaying you means they're exposed, you get paid first. AI is creating brand new threats, so security spending isn't competing with the AI budget, it's part of it. Deferrable or urgent, that's the whole thing. Ask it about anything you own. Is this company's revenue something a customer can push to the next quarter when something scarier shows up in the budget? If yes, it's being drained.
Is this a case of tech companies deferring budgets for anything that's not AI related? And if you don't, we're going to see this across a number of companies. Is that what's happening here?
I think absolutely right in that case. And not just AI, it's actually hardware purchases. So if you have to update your servers, storage devices, etc., they're going to get more expensive next quarter. So you're going to divert all those fundings because remember, memory prices are just rising. So what happened in the case of IBM, their customers were basically saying that if we have to buy servers, we got to do it now because next quarter they're going to get more expensive. So all that funding got diverted. So that is one big area. So they may be related to AI and they may not be, but doesn't matter. You're buying more hardware today at the expense of other areas.
And then there's one test that settles it, and it's free. The company says the deal's slipped. Fine. Next quarter will tell you if that's true. If the revenue shows up, it was timing. People held their breath, and then they bought. If it doesn't show up, the budget didn't get delayed. It got reassigned. Permanently. 1 quarter late is an air pocket. 2 quarters late is the new normal. That's not a forecast. It's a receipt. And it arrives on schedule 4 times a year. So let me bring this home. The cannibalization, the concentration, the crash. IBM faltered because clients drained their software budgets to panic buy AI hardware. That same hardware boom is starving a sector that makes up almost 40% of your index, and the crowd is buying the very stocks getting eaten. The money flooding into AI didn't come from thin air. It's being pulled straight out of the software you already own. The crowd sees a bargain. The patient investor sees which side of the trade is doing the eating. And that's it from me. If you enjoyed this video, hit the like button, subscribe, and I'll see you in the next one.